Now, that doesn't have anything to do with student loans, but what does have to do with student loans is the second major element of buying a home, and that is the debt to income ratio. And debt to income ratio is an expression of how much of your monthly income is swallowed up by your monthly bills. The easiest math I can give you is if you have $10,000 worth of monthly income and $5,000 of monthly debt payments, you have a 50% debt to income ratio. We're actually going to put an article in the show notes that kind of gives you some rules of thumb, even though I'm loath to share rules of thumb. But if you're looking on screen, you're looking at an article from Bankrate, and it gives you some guidance in terms of what's a good, average, or poor debt to income ratio. When it comes to lenders, most are going to want you to be below 36%. 36 to 49% is okay, where you may be able to be approved for a home loan, but it's not ideal. And then above 50% is typically where you start to see people get declined for the type of home for which they're applying. And your debt to income ratio can be the difference between you qualifying for the amount of mortgage that you actually need to buy the home that you're looking for, or whether your lender says, hey, we just can't approve you for that much additional debt. Here's how much we can approve you for. And it ends up just not being enough to buy a home in your area, which happens all the time in Nashville and any other market that has become very, very expensive over the last few years. So now that you understand the guidelines, hey, I got to stay below this amount, otherwise I may not be able to be approved.